Hey guys, welcome to Investify, where we help you grow your wealth through smart investments. Today, we'll be talking about leveraging the 2023 recession to achieve financial prosperity. This unique opportunity may only come around once in a generation and has the potential to greatly enhance your net worth. Yes, you heard it correctly. If you possess the necessary knowledge and skills, this could be an incredibly favorable period to sustainably increase your wealth. And the best part is that we are here to guide you through the process. Despite the negative headlines, we're actually moving towards a point where riches are made in recession. In fact, even Warren Buffett has said that bad news is an investor's best friend. So let's dive into what's expected to happen over the next 12 to 24 months, the benefits you can take advantage of today, and exactly what you need to do to make sure you're in the best position to make as much money as possible. But before we get into the details, let's talk about what you're up against. First and foremost, we need to talk about recession. Typically, recessions are accompanied with a significant rise in unemployment. A recession is more than just a dip in the economy. It can cause wages to drop, consumers' confidence to decrease, and values to decline across various sectors like stocks, food, energy, and services, and these effects can last for years. Furthermore, recessions have a negative impact on corporate earnings. Recent quarterly reports have shown slow or negative growth, resulting in squeezed earnings and job cuts on a larger scale. This cumulative effect leads to a substantial reduction in aggregate demand. In fact, numerous companies have already started laying off their employees, with Bank of America warning of an estimated 175,000 job losses per month in the United States. Now, don't let this news discourage you. Instead, let's use this information to our advantage and figure out how you can make money during these tough times. Let's start with the first point: stocks. Three major indexes have dropped between 20 and 30%, and experts like JP Morgan predict that there could be another 20% decrease from the current levels. However, if we look back through history, the average bear market drop since 1946 was close to 30%, with the most severe being in 2009 when the S&P 500 fell 57% from its peak. When combined with a recession, bear markets tend to perform even worse, with an average drop of 34.8%. Right now, we're down about 25%, but typically the bottom occurs when there is capitulation among investors. This is usually the time when the recovery begins, and things start to bounce back. Moving on to the second point, real estate. While each market is unique and some areas may continue to thrive, national housing declines are quite rare. Over the past 60 years, there have been only a few instances where prices significantly fell more than 10%. However, the general consensus on Wall Street is the national housing prices will decline by 7%, with a worst-case scenario of 10% to 15% drop of interest rates and continue to increase. Moody's Analytics predicts that the most vulnerable markets, including areas of Florida, Arizona, Idaho, and Southern California, could see declines of up to 25% from their peak. This decline could last around 12 to 18 months before bottoming out. For those with a fixed-rate mortgage who plan to stay in their property for another 5 to 10 years, it may not make much of a difference. However, those looking to invest or buy a house may find some good deals coming on the market soon. Lastly, the third point, cash. Until now, many people believe that cash was losing value to inflation. However, when all other assets are declining in price, cash could be the safest place to store your wealth. Billionaire Ray Dalio has even admitted that cash is no longer trash. In 2018, cash was the best performing asset. And if you had saved your money in a high-yield savings account, you would have outpaced the market significantly. Cash is now becoming an increasingly significant part of portfolios, with fund managers holding the highest amount of cash since 2001. Citigroup even suggests that cash is the only asset that investors could use as a recession hedge. In the next few minutes, we'll cover what you can do to make money during this time and why many people fail to take advantage of the opportunities presented by economic downturn. What actions can you take to capitalize on these opportunities? And why do many individuals fail to seize what's right around the corner? In terms of why this recession could be a once-in-a-generation opportunity, the following aspects are what you need to consider. The first aspect is that everything becomes more affordable. This recession could be a great opportunity because things become cheaper. While some may think that it's a bad time to invest, a wealthy person sees it as a chance to buy the same companies at a discounted price. As Warren Buffett once said, "When hamburger prices go down, we sing." The same is true for buying stocks. Reframe your mindset because a dropping market could actually benefit you. The second aspect is the reduced competition. As many companies often scale back their expenses in order to preserve cash and maintain stability, this creates opportunities for smaller and more aggressive companies to take their place. Research has shown that companies that continue to advertise during a recession can increase their value and experience growth in the years following the recession. The third aspect is the abundance of opportunities. Interestingly, a recession serves as a way for the market to eliminate weaker players and create space for new, smaller businesses and individuals to thrive and grow. This is similar to how a forest fire clears out the weaker trees, allowing newer and stronger ones to grow. Patrick Bet-David compared the peak of the market cycle to a forest in this regard. This means that the only largest, most established companies dominate resources, like tall trees accessing sunlight. Small businesses struggle. Economic downturns create space for newer companies to grow. The fourth aspect is that after every bear market comes a bull market. As Yahoo Finance points out, historically the S&P 500 has fallen an average of 29% around a recession, with a media drop of 24%. But once stocks have found their low, their average return the following year is 40%, and within 2 years, the market has increased an average of 58%. This means that investing on the way down is much more profitable than pulling out of the market and waiting. And long-term, the market has always recovered in every single example so far throughout history. Finally, the fifth aspect to consider is the importance of acting before others become aware of the opportunities that a recession presents. However, it is easier said than done. Typically, recessions are not officially confirmed until they are about to end, as the case with the Great Recession of 2007, which was only announced in December 2008. So, what can you do? Number 1. Scale back on your expenses. This means that it is crucial to keep track of your market. Cut back on unnecessary expenses and operate lean while continuing to reinvest as much as possible back into the market. This should also include a plan on what you would do if your income were to drop 20 to 50%. How would you make up the difference? And if you could take preventive measures ahead of time to protect yourself from that happening. Number 2. Hold on to some cash. Even though statistically your money is best off invested as soon as possible, there is something to be said about the peace of mind of having cash on the sidelines just in case something falls through. By proactively taking these measures, you can position yourself to make the most of the opportunities presented by a recession. Number 3. Protect your career. This, at the end of the day, is going to be your best hedge against whatever happens because financially, your worst case is not just experiencing a market downturn, but also losing your job simultaneously, followed by investment losses before having a chance to recover. So now is the best time to improve yourself, learn new skills, and double down on whatever you're currently doing. Therefore, it is crucial to focus on safeguarding your career. Number 4. Focus on long-term investments. It is generally better not to invest any funds that you will need within the next 5 years. The key is to maintain a consistent approach and continue with dollar cost averaging or regular interval purchases. This proven strategy, observed over time, yields profitable results. Therefore, stay in the market and continue buying. Number 5. Diversify your investments. If you can't personally handle a 20% drop without panicking, it's probably a sign that you're invested too aggressively. In such cases, consider diversifying your portfolio by investing in different asset classes. For instance, if you have invested in US tech stocks, consider adding real estate to your portfolio, as it tends to have more stable rents. By diversifying your portfolio, you will have a stronger foundation and be less susceptible to collapse. Furthermore, now is an excellent opportunity to redouble your efforts, embrace a side hustle, and expand your knowledge base. The actions you take today will yield manifold rewards once the market rebounds. While the road ahead may not be smooth, it's crucial to remain steadfast because those who persevere will reap the benefits. We look forward to hearing your thoughts and experiences in the comment section below. Let's embrace the potential of a falling market and seize the advantages it presents. Well, that's it for today. Thank you for watching. Don't forget to like this video, subscribe to our channel, and ring that notification bell for more updates here on Investify.